The value of finance actually doesn't arise in finance itself. Real value is actually created in the real world, surprisingly enough. And we seem to have lost sight of that. So when we're talking about value-adding finance, what we're saying is look to what finance does. What it does enables people to do in the real world. It's as simple as that. It just seems as if we've slightly lost sight of that in our enthusiasm to expand the financial system. We focus too much on the financial system itself and lost sight of the fact that financial services themselves don't really create value intrinsically. They enable value to be created elsewhere. We had thought 13, 15 years ago when we started that all we needed to do was to establish access to financial services for lower income people, for smaller scale businesses that previously had not had access to it, and that the solutions to their problems would arise naturally, that markets would evolve, that real world solutions would come out of that. We realize now that with financial inclusion at levels unprecedented in Kenya's history, that isn't really happening. What we are seeing is that lots of people have accounts in various forms, but those accounts are not being used. And the reason for that is that they're not really solving real world problems for them. And so in order to address that, we have to go back to basics and say, well, what are these financial services for? What are they actually doing for people, for ordinary people in their everyday lives? So what we want to do is to go back into the real world and say, well, how can value be created? And when you start to ask those sort of questions, you get down to some pretty basic points. So people want to send their children to school. They want to be able to plan for an emergency, which you can't see. They want to be able to invest in a business. They want to be able to retire when they're old aged and they can no longer work. All of those things can be facilitated by financial services, or rather financial solutions which enable people to move money around, to invest in new businesses, to take credit where it's appropriate. But we have to start from the point of view of where the value is going to be created, which is in the real world, not in financial services themselves. 15 years ago, relatively few Kenyans had access to any form of formal financial service. So naturally our immediate focus was on how do we get people access. And so we invested a great deal of time, energy and effort in trying to improve levels of access. And at the time we assumed that if we overcame those barriers, that good things would arise naturally as a consequence. Once people had access to financial services, they would use them for useful purposes and we would see the developmental outcomes that we were after. Fast forward to today, and we have unprecedented levels of access to financial services in Kenya. In fact, Kenya is one of the leading countries in the world in terms of access, given its level of GDP. However, what we're finding is, even though many people now have a financial service where they wouldn't have previously had them, they're not making very much use of them. And the reason for that is fairly stark, that those financial services were not designed for the needs that ordinary Kenyans actually have. And so now we have to go back to basics again and say, okay, why are people not using those financial services? And we think the reason is because there's not enough value in them. They're not actually doing particularly useful things for people. So our focus now is to say, okay, we think there are ways in which financial solutions can generate value for people, but we can't just expect that to arise spontaneously. We need to find out how to do that. There are very promising instances of financial services offering real value to people, but equally there are many instances where financial services are either not particularly useful, accounting for the huge number of accounts we see which are basically dormant, or, and this is the worst case, we find financial services being actively harmful, where people are borrowing in unsustainable ways or applying it for purposes which later they have cause to regret, sort of things like online gambling. So we have to accept that financial services actually can be a double-edged sword, and what we need to focus on is how do we create financial services which are really valuable to people, and also how do we minimize those negative cases. I think we want to see a financial system that delivers solutions to real-world problems. And I think language can be important in this. We should move away from talking about financial products and financial services and talk more about financial solutions, because what that does is emphasize what the end game is, which is to solve people's problems. So we need to go back to basics and say, what is it that we need to do with finance in order to enable a mother to send her 2 children to school? What do we need in order to enable a baker to expand his business so that he's able to take up an opportunity to supply bread to the local hotel? How do we allow a smallholder farmer to increase her number of chickens from 10 to 40? How does she find a market for those chickens? That's what we've got to be thinking about, and then say, well, what has to happen from a financial point of view in order to take those opportunities? We have to be modest when we're looking to the future. We can't pretend that we see incredibly clearly what a value-adding financial system would look like, but we can have some ideas of what the characteristics of such a system should be. Most obviously, of course, is at core that we can see evidence of real value being created. But that's not answering the question. What might it look like? What are the elements? What might be the building blocks? And we think we've got to look at this at probably 3 levels. First, we've got to have the players in the market who are pursuing innovation for the design of products or solutions better, which offer real value. So that means a different type of financial service provider. It means a financial service provider who's really focused much more on the real economy and what people use financial solutions for than in the past, where in a sense the tradition has been that the bank expects the customer to come to the bank. Rather, now we want to see the bank or the financial service provider, it doesn't need to be a bank, comes to the customer. And that's more than literally, although that matters too. It's actually metaphorically about trying to get out of the mindset of designing standard financial products, a current account, a credit card, a debit card, an insurance policy, and going out to see what ordinary people need to achieve in their daily lives in order to make those lives better in some meaningful sense. So that's about the type of providers we want and the way in which they go about developing new financial solutions. In order to underpin that, in order to make that a real prospect, you need what we think of as infrastructure, financial sector infrastructure, which underpins providers being able to compete with one another and deliver solutions at extremely low cost. Key parts of that are things like the payment system. The payment system enables money to flow readily throughout the economy and crucially enables competition between different providers. So that's one element. Information sharing is probably going to be transformational in our financial system. If information about what people need, how they behave, their risk profiles can flow readily across the financial system, we open up new possibilities, not just in competition, but also in how risk can be managed, how services can be provided. So that's a crucial piece, this notion of information flows across the economy. There are other elements which are important but perhaps less obvious, things like collateral, enabling people to register their collateral and move it among different providers readily. These sort of things seem a little prosaic, but they can be tremendously important in terms of the costs of financial service provision. So we need to keep working on those with a view to both driving down the unit transaction costs, but also making it possible for providers to compete, because it's from that competition that we're likely to see the real innovations that make a difference to people. And then finally, there's regulation. We mustn't forget regulation. The assumption that good things will always happen in an unimpeded market has been refuted many times now. The 2007-2008 global financial crisis demonstrated absolutely clearly how important it is to appropriately regulate the financial system. So as we look at the prospects of technology changing our financial system and bringing many benefits, we also have to ensure that we're protecting against the negatives. There are already financial service providers in the market in Kenya who are borderline abusive in terms of their approach to customers. Failure to disclose terms and conditions, onerous terms and conditions, lack of complaints resolutions, and of course you've got the downright fraudulent, the pyramid schemes, the Ponzi schemes, which are fleecing ordinary Kenyans of their hard-earned savings. So we need to protect against those problems, ensure that we minimize the downside from a fast developing, a quite dynamic financial system. We need to make sure that we're looking after the way in which providers conduct themselves in the market. So rather than talking about rules-based regulation, which has been the tradition, we need to look much more at outcomes. What are the outcomes from behaviors in the market, and how do we regulate the conduct of players in that market so we end up with good outcomes for consumers and good outcomes for Kenya?